Hey friends, welcome back to Wealth for You, the place where Singaporeans learn how to stay cash flow rich, not paper rich. Today's deep dive is all about Frasers Logistics and Commercial Trust. FY25, 6% yield REIT, DPU outlook and Fed rate cuts, impact explained. If you love passive income, enjoy dividend copy money, or you simply want to understand whether FLCT is still worth holding at today's prices, you'll definitely want to stay till the end because we're breaking down the FY 2025 numbers, the valuation, the dividend outlook, and how 2026 Fed rate cuts could change everything. Before we jump in, remember, this video is strictly for education and entertainment purposes only. It is not financial advice. All financial information in this video is extracted directly from FLCT's official announcements on the SGX website, dated 7th November 2025. Please do your own due diligence and always consult a licensed financial advisor before making any investment decisions. All right, let's dive in. And don't forget to like this video so more Singaporeans can watch it, and subscribe to Wealth for You for more dividend-focused content. Chapter 1. What are REITs? Before we go into the numbers, quick refresher. What's a REIT? A REIT, or Real Estate Investment Trust, is basically a company that owns income-producing properties. As investors, we buy units of the REIT and receive a portion of the rental income as regular dividends. Think of it like pooling money with thousands of other Singaporeans to own 113 warehouses, business parks, and commercial buildings worldwide, and collecting copy money without being a landlord. Chapter 2. FLCT, Portfolio Strength and Resilience. Frasers Logistics and Commercial Trust, or FLCT, is a globally diversified Singapore-listed REIT with a strong focus on logistics and industrial assets, the warehouses, distribution centers, and industrial facilities that keep modern e-commerce and supply chains moving. Today, FLCT owns 113 properties worth about 6.86 billion Singapore dollars, spread across Australia, 45.6%, Germany, 26.2%, Singapore, 12.5%, the UK, 10.2%, and the Netherlands, 5.5%. What truly defines FLCT is its heavy tilt toward logistics and industrial real estate, roughly 75% of the entire portfolio. These assets tend to be more defensive, offering stronger tenant demand and steadier cash flow. That resilience shows up clearly in its numbers. Overall occupancy stands at 95.1%, with its logistics and industrial properties almost fully occupied at 99.7%. The commercial segment is softer at 86.1% but still stable. FY25 rental reversions were strong, with new leases 5% higher than outgoing ones, and an impressive 29.5% uplift on average-to-average rents, driven largely by a 39.6% surge in the logistics and industrial segment. With a 4.8-year WALE, FLCT enjoys solid visibility on rental income. In short, FLCT is anchored by high-quality logistics assets that continue to deliver resilient performance, even as its commercial properties recover more gradually. Chapter 3. FLCT FY25 Results. The good and the bad. FLCT released its half-year and full-year FY25 results on 7th November 2025, showing steady top-line growth but weaker distributions. For the second half, revenue rose 3.7% to 239.2 million Singapore dollars, and adjusted NPI grew 2.2% to $164.9 million. However, distributable income slipped 10.6% to $111.7 million, bringing DPU down 11.1% to 2.95 cents. The drop in DPU was driven mainly by higher interest costs, higher taxes, softer contributions from commercial properties, and FX translation losses from the Australian dollar, euro, and pound. For the full year, revenue increased 5.6% to $471.5 million, and adjusted NPI rose 1.9% to $326.1 million. But distributable income fell 12.1% to $224.7 million. This resulted in a full-year DPU of 5.95 cents, down 12.5% from the previous year. Overall, FLCT's logistics and industrial assets continued to perform well, but higher financing costs and currency pressures weighed on the final distribution. Chapter 4. Is FLCT overpriced or undervalued? At its closing price of 97 cents on the 14th of November 2025, FLCT trades like a REIT with mixed signals. Its market cap sits at roughly $3.66 billion, and on earnings, it's priced at about 17.9 times PEE. Not particularly cheap for a trust with modest growth. But when you look at assets, the picture shifts. With a NAV of $1.10 per unit, FLCT is trading at just 0.88 times book value, a 12% discount that suggests undervaluation based on its property portfolio. Returns, however, are muted. ROE sits around 3.2%, reflecting the slower income growth seen over the year. Gearing remains healthy at 35.7%, comfortably below the MAS ceiling and offering balance sheet stability. So what does this mean? On a PB basis, FLCT looks attractively priced, but the higher PE and low ROE tell us the market isn't willing to pay up for its current earnings. In short, slightly undervalued, but for good reason. Investors are factoring in FX headwinds, higher interest costs, and the softer performance of its commercial properties. Chapter 5. Dividend, Yield, and Sustainability. Sweet or bitter? At a unit price of 97 cents, FLCT offers a yield that will appeal to many income-focused investors. Based on its full-year fiscal year 2025 distribution of 5.95 cents, the trailing yield comes in at about 6.1%, and forward estimates place the yield in the 6 to 6.3% range, depending on where financing costs and FX rates settle in the coming year. For this payout cycle, the ex-dividend date was 18th November 2025, with unit holders receiving their distribution on 23rd December 2025, just in time for some festive COPI money. The question, of course, is whether these dividends are sustainable. FLCT has several strengths working in its favor. Its logistics and industrial properties remain almost fully occupied at 99.7%. It enjoys a healthy 4.8-year WALE, gearing is moderate, and rental reversions remained robust through fiscal year 2025. These create a solid foundation of recurring cash flow. But there are real headwinds too. Higher interest expenses, a still recovering commercial segment, and FX translation losses can all eat into distributable income. Fiscal year 2025 has already shown this, with a 12.5% drop in DPU despite stable property performance. Putting it together, FLCT's dividend looks reasonably sustainable, but meaningful growth is less certain. Think of it like your regular COPI. It'll still arrive, but the sweetness might fluctuate from time to time. Chapter 6. DPU Outlook and 2026. Fed rate cuts. What's next? Looking ahead, much of FLCT's outlook hinges on what happens to global interest rates in 2026. If the U.S. Federal Reserve follows through with meaningful rate cuts, FLCT could see several important tailwinds. Lower borrowing costs would immediately ease one of the biggest pressures on its fiscal year 2025 results. allowing more cash to flow through as distributable income. Falling rates also tend to compress yields across the REIT sector, which could lift unit prices. On top of that, cheaper funding may reopen opportunities for accretive acquisitions, while the continued strength of logistics and industrial demand would help support stable rental income. But investors should also keep an eye on the uncertainties. Rate cuts may be slower or more modest than markets hope, and FLCT's commercial and business park assets still face a less predictable recovery path. Currency movements can also swing distributions, since much of the REIT's income comes from Australian dollars, euros, and pounds. And if property valuations weaken or cap rates expand, NAV could come under pressure. Execution remains important too, especially in securing leases and integrating new acquisitions. Overall, if interest rates do fall meaningfully in 2026, FLCT's DPU has room to stabilize or even improve, given that higher finance costs were the main drag in fiscal year 2025. But commercial softness and FX volatility will continue to be the main wildcards shaping how much of that upside actually reaches unit holders. Chapter 7. What Singapore income investors should consider. When it comes to FLCT, Singapore income investors should approach it with clarity and patience. First, know what you want out of this REIT. FLCT is built for steady, dependable yield, not fast capital gain fireworks. If you're looking for stability more than aggressive growth, it naturally fits that profile. Next, understand that this is a multi-currency REIT. FLCT earns its income in Australian dollars, euros and pounds, but pays dividends in Singapore dollars. So FX swings can affect your COPI money, even when the underlying properties perform well. Keep an eye on interest rates too. With the possibility of Fed rate cuts in 2026, FLCT could see meaningful relief on its interest expenses, which might help stabilize or lift DPU. But until that happens, it's important to keep monitoring the fundamentals: occupancy, rental reversions, cost of debt, property valuations, and how quickly the commercial segment recovers. And of course, never chase yield for the sake of yield. Take time to assess the balance sheet and how sustainable the distributions really are. FLCT's logistics portfolio is doing the heavy lifting today, but commercial recovery may take time, so patience is part of the game. Final thoughts. So that wraps up our breakdown of Frasers Logistics and Commercial Trust, fiscal year 2025 6% yield, REIT, DPU outlook, and Fed rate cuts, impact explained. At 97 cents, FLCT looks slightly undervalued, delivering a 6% plus dividend yield, and it stands to benefit if 2026 rate cuts play out as expected. But it's not without challenges, especially in its commercial segment and from FX movements that can easily swing returns for Singapore investors. If this video helped you understand FLCT better, please like this video so more Singaporeans can watch it, and subscribe to Wealth for You for more dividend-focused breakdowns. And I'd love to hear from you. Do you think FLCT is a buy, hold, or avoid at today's price? Drop your thoughts in the comments below. This is Wealth for You, helping you stay cash flow rich, not paper rich. See you in the next video.